Every empire, as if breaking new ground, believes it has invented a unique new monetary system of its own. But eventually, every empire faces the same reality. Money works according to its own rules. Stubborn, immutable rules unaffected by politics, promises, or fancy rhetoric. These rules are neither written in constitutions nor taught in schools. Throughout history, they are discovered amidst crises, forgotten, and then rediscovered like the same slap in the face. And if you don't know them, you will never understand why the system always feels like it is collapsing on top of you. Tonight, we open the book on these forgotten laws of money, from Rome's diluted coins to the digital games of today's central banks. And you will understand, the game was never fair from the start. Let's begin with the most fundamental and bitter reality, Gresham's law. In the 1500s, Sir Thomas Gresham summarized this to Queen Elizabeth I in a single sentence: bad money drives out good. The logic is simple. If two types of money, one trustworthy and one debased, circulate simultaneously in a country, people spend the bad money and hoard the good. This is exactly what happened in Rome. When the silver denarius was mixed with cheap metals over time, the public wasn't stupid. They paid the state, taxes, and debts with those junk coins. The real, pure silver they buried in a corner of their homes. The same game played out in medieval Europe when kings replaced gold with copper. The lesson is clear. If the state attempts to dilute the currency through trickery, the public makes an immediate counter-move. They circulate the bad and hide the good. And the moment this begins, trust in the system starts to dissolve. But this has a dark twin: Thiers' law. Originating from 19th century France, this rule states that in a moment of collapse, the game reverses. When a real crisis hits, good money drives out bad. Think of Weimar Germany. Prices double every few days. Wheelbarrows full of banknotes buy a single loaf of bread. In such an environment, no one wants to hold marks. Everyone flees to dollars, gold, cigarettes, or even barter, that is, to what has real value. The same thing happened in Zimbabwe, in Venezuela, in all hyperinflations. Thiers' law is the moment the system collapses, the moment the public completely throws the value promised by the state into the trash. Gresham describes the slow rot. Thiers describes the sudden death. So what happens in the gray, squeezed zone between the two? Here, the Cantillon Effect comes into play. The law explaining why inflation always coincidentally enriches the wealthy and makes the poor poorer. In the 18th century, Richard Cantillon noticed something very simple. When new money enters the economy, it is not distributed equally to everyone. Those closest to the source, the government, banks, big capital, are the ones who spend the money first. By the time the money reaches the public, the worker, or the shopkeeper, prices have already risen. The early birds buy goods and assets at yesterday's prices. The latecomers pay tomorrow's prices. The Cantillon Effect explains why printing money always enriches the upper class and crushes the lower class. It explains why monetary expansion after 2008 sent stock markets soaring but didn't budge wages. It clarifies why pandemic stimulus evaporated from people's pockets straight onto supermarket shelves. Inflation is not just a percentage, it is a silent transfer of wealth. And you are not at the winning side. But what is even more bitter is this. The system is established to work exactly this way. Benefit flows up. The cost is dumped down. The public feels robbed but cannot see who to blame. The Cantillon Effect is the secret cheat code of modern finance, and it had functioned since the first coin was minted. The second stage of this business is financial repression, the method of government silently wiping their debts from the people's pockets. After World War II, countries were grappling with mountains of debt. They couldn't raise taxes, it would cause a revolt. They couldn't default. Their reputation would collapse. They found the solution. Lock the public inside the system, push real interest rates into the negative, silently melt away savings. Interest rates were pulled below inflation. This meant your savings account was guaranteed to lose money every year. On top of that came capital controls. Moving your money abroad, or even buying alternative investments, became difficult. The result? The public lost wealth without realizing it. The state melted its debts. And most people never even heard the name of what happened. Today the same game is being played again. Post-2008, interest rates stayed at near zero for 10 years. In 2020 to 2021, they collapsed again. While your savings melted, asset prices, stocks, homes, land, soared. This was not a mistake. This was modern financial repression. But the laws of money are not limited to this. Some determine the fate of entire empires. Next is the Triffin Dilemma, the reserve currency trap. In the 1960s, Robert Triffin warned the U.S. Congress. If the dollar was to be the world reserve currency, the U.S. had to run a constant trade deficit to distribute the dollars the world needed. In the short term, this was beneficial. World trade grew. But in the long term, it injected poison into the system. The more dollars America distributed, the weaker the dollar's link to gold became. Trust grew fragile. When Nixon ended the gold standard in 1971, Triffin was proven right. Since that day, the U.S. has run a constant trade deficit. It exports dollars, it imports goods. Factories close, debt grows, but the power of the dollar keeps the game going. The bitter truth of the Triffin Dilemma is this. Both the crown and the curse of being the reserve currency rest on the dollar's head. And today, as rivals approach, the cracks are widening. BRICS is looking for alternatives. China and Russia are trying to exit the dollar, and central banks are buying gold at the fastest rate in decades. Next is another bitter truth. Goodhart's Law. In the 70s, Charles Goodhart said this. When a measure becomes a target, it ceases to be a good measure. States and central banks are obsessed with numbers. 2% inflation, 5% unemployment, 3% growth. These numbers exist to reflect reality. But when politicians turn them into targets, they begin to hide reality. This is what happened with inflation targeting. To make inflation look low on paper, interest rates were manipulated, liquidity was pumped in, and asset bubbles were inflated. Housing, healthcare, and education prices skyrocketed. Official figures said stable. The public said we can't make ends meet. The same thing happened with GDP. Growth was sanctified, and governments pretended to grow through debt. The number went up, but the country's resilience collapsed. Goodhart's Law is clear. When you start playing with the numbers, you become unable to measure reality. And our final law, the law of diminishing returns on debt. It's not an elegant phrase, but it is today's most bitter mathematics. The economy strengthens in the early stages of debt. $1 debt, $1 growth. But over time the yield drops. $1 debt, 50 cents growth, then 25 cents, then almost zero. And debt increases, but the economy doesn't speed up. The system begins to groan under the weight. We are exactly here today. U.S. debt is 30+ trillion. New debt creates no real prosperity. It only keeps rotten financial markets standing. Every empire arrived here: Rome, France, Britain, and now America. The law is clear. Debt does not save you, it only buys time. What do all these laws tell us? Money has no magic. It has real, cold, hard rules. Bad money drives out good. Crisis brings the good back. New money makes the rich richer, the poor poorer. The government silently wipes its debt from the public's pocket. The reserve currency rots itself from the inside. Targets distort reality, and debt eventually lays dynamite beneath the system. These are not coincidences. This is the harsh rhythm of financial history, and the hardest truth of all. This game was not designed for you to win. You live in transparency. Elites live in secrecy. You pay taxes. They hide assets. You hold cash that loses value. They hold assets that gain value. The system plays by its own law. If you don't know that law, you will be crushed beneath it. History may not repeat itself, but the laws of money never change. If you don't understand them, the consequences will crush you all the same.